This presentation explores a high upside mining stock thesis built around a potential precious metals bull market into 2030. The focus is on 7 mining stocks that could benefit most from rising gold and silver prices, operating leverage, and sector revaluation. The central argument is not that every miner will produce extraordinary returns, but that carefully selected companies with the right mix of quality, leverage, and growth exposure could outperform dramatically if the macro environment turns strongly in favor of metals. This is a speculative framework, so the key is understanding both the upside drivers and the risk involved. The historical case for mining stocks is that junior and mid-tier miners can vastly outperform the metals themselves during a strong bull cycle. In prior periods, a relatively small move in gold or silver often translated into much larger moves in select mining equities. This slide highlights that asymmetry. The core idea is that when sentiment, valuation, and metal prices align, quality mining stocks can re-rate quickly. The example shown here is intended to illustrate how significant upside has occurred before, especially in speculative resource cycles, and why investors still look to miners for outsized return potential. The first major driver behind a high-return mining thesis is a strong move in metal prices. This slide assumes a bullish macro environment where gold rises sharply and silver moves even more aggressively. The rationale combines monetary expansion, central bank gold buying, supply constraints, and stronger industrial demand for silver. Whether or not an investor agrees with the most aggressive price targets, the key point is that miners are highly sensitive to underlying metal prices. If gold and silver move meaningfully higher, many mining companies could see a disproportionate increase in cash flow, net asset value, and market interest. The second and third drivers are operating leverage and valuation re-rating. Mining is a business where costs are relatively fixed in the short term, so when metal prices rise, margins can expand quickly. That is operating leverage. On top of that, mining stocks often begin bull markets undervalued because the market does not fully price in higher future metal prices. As sentiment improves, multiples can expand as well. That means investors may benefit from 2 layers of upside. First, higher earnings and cash flow, and second, a higher valuation multiple applied to those stronger fundamentals. This slide presents the China factor as a major macro catalyst. The argument is that large-scale gold accumulation, reserve opacity, and strategic positioning by China could contribute to a much stronger repricing of gold over time. If gold moves substantially higher, the effect would spread across the mining sector through asset revaluation, better project economics, and greater merger and acquisition activity. The important takeaway is not just the China narrative itself, but how a large gold price reset could transform the value of marginal deposits, developers, and smaller producers across the sector. The first 3 stock ideas focus on silver and diversified exposure. First Majestic is presented as a high-torque silver producer with strong sensitivity to rising silver prices. Endeavor Silver adds operational growth and expanding production potential, which can amplify gains in a bull market. Mag Silver is different because of its high-quality exposure to Juanicipio, one of the strongest silver assets in the sector. Together, these names represent a mix of pure silver leverage, production growth, and high-grade asset quality. The idea is to combine torque with operational strength rather than rely on only one type of company. The next 4 names broaden the portfolio across gold, silver, and exploration-driven upside. Kerr is framed as a diversified North American producer with improving asset leverage. Silvercrest is highlighted for its high-grade, low-cost Las Chispas profile. Barrick represents the lower-risk large-cap anchor in the list, offering safer gold exposure and valuation upside if gold re-rates. Dolly Varden adds a speculative exploration angle, with the potential for resource growth and M&A interest. This mix shows the intended structure of the basket, not just speculation, but a layered combination of quality, leverage, scale, and optionality. This slide turns the idea into a practical portfolio structure. The allocation spreads capital across 7 names, balancing larger and more stable companies with more speculative upside plays. Barrick receives the highest weight as the safer anchor, while the others offer varying degrees of silver leverage, production growth, or exploration torque. The return scenarios are based on aggressive assumptions for gold and silver prices, so they should be treated as illustrative rather than predictive. The purpose is to show how portfolio construction affects the outcome when combining different types of mining stocks under a bullish metals scenario. A strong return thesis still needs a timing framework and clear risk controls. This slide lays out a staged cycle, from early positioning to recognition, acceleration, and eventual market mania. The implication is that the best returns usually come from entering early, before broad participation arrives. But this also requires discipline, because mining stocks are volatile and can be heavily affected by metal prices, operations, policy changes, dilution, and liquidity conditions. The risk rules shown here are practical. Diversify, size junior positions carefully, avoid leverage, and keep reviewing the original investment case as conditions evolve. The conclusion ties the whole thesis together. The opportunity described here is based on the view that an important gold and silver bull market may still be ahead, and that selected mining stocks could benefit from higher metal prices, operating leverage, and valuation expansion. The 7 names in the presentation are intended as a focused basket that combines safety, torque, and optionality. But the core message is also one of caution. Extraordinary upside only matters if the thesis is correct and risk is managed properly. For investors, the real task is disciplined selection, position sizing, and constant review.